In Beijing, French President Emmanuel Macron smiles for the cameras, signing a series of lucrative trade deals. In São Paulo, Brazil's President Lula da Silva speaks passionately at a global summit, not of a new alliance, but of a new trade currency for the BRICS nations, a system designed to bypass the traditional financial order. And in Riyadh, a monumental 50-year-old agreement between the United States and Saudi Arabia, the very bedrock of the dollar's global dominance, quietly expires without renewal. On the surface, these are disparate international news items, easily lost in the chaotic 24-hour news cycle. A trade visit here, a political speech there, a diplomatic agreement lapsing. But if you are trained to look for patterns in the grand chessboard of geopolitics, and you begin to connect these seemingly unrelated dots, a startling and undeniable picture emerges. The mainstream media often frames the world in simplistic terms, a clear confrontation between the United States and its declared adversaries. But the real story, the far more significant story for the future of the global order, is not about America's enemies. It is about America's friends. In this analysis, we will not focus on the loud rhetoric of confrontation. We will examine the quiet handshakes. We will deconstruct the pragmatic, hard-nosed business decisions that are methodically reshaping the map of global financial power. And we will answer the critical question, why are America's closest, most vital allies secretly preparing for a world no longer dominated by the US dollar? To comprehend this shift, one must first discard the sentimental notion of alliances. In the cold calculus of international relations, there are no permanent friends, only permanent national interests. For the better part of 70 years, aligning with the US dollar system was the paramount economic interest for nations across the globe. It provided stability, access to the world's largest market, and the security of the American military umbrella. But what happens when the balance of those interests begins to shift? What happens when a viable alternative begins to emerge? This is the core of China's grand strategy. It is not a strategy of direct military confrontation with the United States. It is far more subtle and far more patient. Beijing is not shouting from the rooftops, "Abandon the dollar." Instead, it is building a parallel economic ecosystem. Through initiatives like the Belt and Road, it has woven a new network of trade routes and infrastructure. It has developed its own cross-border interbank payment system, or CIPS, as a functional, albeit smaller alternative to the Western-dominated SWIFT. And most critically, it is signing long-term energy contracts like those with Russia and the Gulf states, denominated not in dollars, but in its own currency, the yuan. China's proposition to the world is not a demand for loyalty. It is a business proposal. It says, here is another option, an efficient and stable one, that comes without the political strings or the threat of sanctions that are inherent to the dollar system. And to understand why so many of America's allies are now listening intently to that proposal, we must first travel back in time to the very moment this dollar-centric world was forged. We must understand the alliance that built the dollar empire. The alliance that built the dollar empire. The story of the dollar's absolute power begins not with a bang, but with the quiet collapse of an older system. Following the Second World War, the Bretton Woods Agreement established the US dollar as the world's reserve currency. Its strength was guaranteed by a simple promise. Any nation holding dollars could, at any time, exchange them for a fixed amount of gold from the US Treasury. The dollar was, quite literally, as good as gold. This system provided the stability needed to rebuild the world. But by the late 1960s and early 1970s, the economic pressures of the Vietnam War and growing domestic spending put that promise under immense strain. Other nations, seeing the U.S. printing more money than it had gold to back, began to call America's bluff. On August 15, 1971, President Richard Nixon appeared on television and delivered what would become known as the Nixon shock. He unilaterally severed the U.S. dollar's convertibility to gold. In an instant, the foundational principle of the global financial system for the previous quarter century was gone. Without the backing of gold, the U.S. dollar was now a fiat currency, its value based on nothing more than faith and credit. By all logic, it should have collapsed. A global panic should have ensued as nations rushed to dump their dollar reserves. But Washington had an audacious, ingenious plan. A plan to replace gold with a different, even more essential commodity: oil. In 1974, U.S. Treasury Secretary William Simon was dispatched on a secret mission to Saudi Arabia. The world was reeling from the OPEC oil embargo, which had sent energy prices soaring and economies into a tailspin. Out of this crisis, a world-altering deal was struck. The structure of the agreement was one of elegant, brutal simplicity. Saudi Arabia, as the undisputed leader of OPEC, would agree to price all of its oil exports exclusively in U.S. dollars, and it would use its influence to ensure the rest of OPEC did the same. In return, the United States would provide the Saudi kingdom with advanced weaponry and an ironclad military security guarantee. But there was a crucial second component: the massive profits that the Saudis would earn from these dollar-denominated oil sales. Billions upon billions of petrodollars would be recycled back into the United States. The kingdom would use these profits to purchase U.S. Treasury bonds, effectively lending that money back to the American government, helping to finance its deficits. The petrodollar system was born. Its impact was immediate and profound. It forced every single oil-importing nation on Earth, whether friend or foe, to acquire and maintain vast reserves of U.S. dollars in order to purchase the energy that fueled their economies. This created a permanent, artificial global demand for the American currency. This constant demand is what has allowed the United States to run massive trade deficits and accumulate staggering levels of national debt for decades without facing the consequences that would have destroyed any other currency. America's hegemonic power in the post-war era was not built on gold. It was built on oil, priced in dollars. And for precisely 50 years, that system held. Then on June 9, 2024, that foundational 50-year agreement quietly expired. It was not renewed. Now, this does not mean that Saudi Arabia will stop selling oil in dollars overnight, but it does mean that for the first time in half a century, the kingdom is legally and diplomatically free to sell its oil in any currency it chooses: the yuan, the euro, the rupee. The exclusive arrangement is over. So when you hear reports of Saudi officials publicly discussing the possibility of accepting yuan for oil sales to China, this is no longer just a hypothetical threat. It is the sound of a seismic tremor running through the very foundation of the 50-year-old world order. And the aftershocks are now being felt across America's other key alliances. Europe's dangerous double game. Nowhere is this conflict of interest more acute than in the economic heart of Europe: Germany. For Germany, China is not seen primarily as a geopolitical rival. It is viewed first and foremost as the single most important customer and an indispensable part of its manufacturing supply chain. The German economic model, a powerhouse of high-end manufacturing, is profoundly intertwined with Chinese demand. Consider the automotive industry, the crown jewel of the German economy. While exact figures fluctuate in recent years, the Chinese market has often accounted for the largest single source of sales for titans like Volkswagen, BMW, and Mercedes-Benz. For the CEOs in Munich, Stuttgart, and Wolfsburg, losing access to the Chinese market is not just an option to be considered in a foreign policy debate. It is an existential, apocalyptic scenario. This dependence extends far beyond cars. Chemical giant BASF, a bellwether of German industry, has invested billions in new facilities in China. The famed Mittelstand, the small and medium-sized engineering firms that form the backbone of the German economy, have built their prosperity on selling specialized machinery to Chinese factories. This deep economic integration places Berlin in a strategically impossible position. On one hand, its national security is fundamentally reliant on the NATO alliance and the American security umbrella, especially in the wake of renewed Russian aggression. On the other hand, its economic prosperity is inextricably linked to the goodwill of Beijing. The result is a foreign policy of calculated ambiguity, a constant, precarious balancing act that seeks to appease both Washington and Beijing simultaneously. This is a dangerous double game, and one that is becoming increasingly difficult to sustain as tensions between the U.S. and China escalate. It makes Germany, at best, a reluctant and hesitant partner in any serious economic confrontation with its largest trading partner. This same dilemma is echoed, with a slight variation, in Paris. France has long harbored a Gaullist ambition of strategic autonomy. This is a deeply ingrained desire to be a major pole in a multipolar world, independent of the dictates of either Washington or Beijing. This ambition is now fueled by a powerful economic reality: the dependence of its luxury goods industry on the Chinese consumer. For conglomerates like LVMH and Kering, owners of brands from Louis Vuitton to Gucci, China represents the single most important engine of growth. According to recent financial reports from late 2025, the recovery of spending by Chinese tourists and wealthy consumers is seen as the vital factor for the entire European luxury sector's health. When French President Macron travels to Beijing, flanked by a delegation of top French CEOs, it is not merely a diplomatic courtesy, it is a high-stakes sales mission. His public statements, therefore, must be viewed through this lens. When Macron insists that Europe must resist the pressure to become America's followers, or that the continent should not get caught up in a U.S.-China conflict over Taiwan, he is not just speaking to a domestic audience. He is sending a clear, unambiguous signal to his hosts in Beijing. France is open for business, and its foreign policy will be guided by its own economic interests. The fundamental problem for this Franco-German strategy is that Europe does not speak with a single voice. While Paris and Berlin pursue this delicate balancing act, the nations of Eastern Europe, facing a direct threat from Russia, are more dependent on American security guarantees than ever before. This internal division paralyzes the European Union's ability to forge a coherent, unified foreign policy, and it creates perfect conditions for Beijing to exploit these fractures, offering economic incentives to some nations while applying pressure to others, further weakening the transatlantic alliance from within. The Pacific powder keg. The same fissures are appearing in America's key alliances in the Pacific. Let us first consider Japan. As America's closest and most important ally in Asia, Japan finds itself in an economic trap largely of its own making, a slow-motion crisis that has been building for 3 decades. Japan's public debt is staggering. By the end of 2025, it is projected to stand at approximately 235% of its gross domestic product. This is one of the highest ratios in the entire world. To prevent a catastrophic debt crisis, the Bank of Japan has been forced to pursue a policy of near-zero interest rates for years, effectively printing trillions of yen to buy up its own government's bonds. In fact, the central bank now owns more than half of all outstanding Japanese government bonds. This monetary policy has had a devastating effect on its currency. The Japanese yen has fallen to multi-decade lows against the US dollar. For export giants like Toyota or Sony, a weak yen provides a short-term competitive boost, making their products cheaper on the global market. But it is a double-edged sword. It makes the import of energy and food, 2 things Japan is critically dependent on, ruinously expensive for its citizens. More importantly, this precarious economic situation leaves Japan extremely vulnerable to external shocks. Washington can and does ask Tokyo to join in economic sanctions against China. But for Japan, a full-blown trade war with its largest trading partner is not just a strategic consideration. It could be the very event that pushes its fragile, debt-laden economy over the edge. It is a loyal ally, but one held hostage by its own economic fragility. Then there is the case of Australia, perhaps the most profoundly conflicted of all America's allies. No other developed nation on Earth has hitched its economic wagon to China's star as completely as Australia. Its entire modern economic model is predicated on a simple transaction: digging vast quantities of natural resources out of the ground and shipping them to the ports of China. The numbers are stark. Iron ore is the most critical commodity. In 2024, Australia supplied nearly 70% of China's total iron ore demand. The single commodity accounts for a massive portion of Australia's GDP. The same story is true for other resources like coal and natural gas. Canberra has already had a taste of what happens when Beijing decides to use this economic leverage as a weapon. A few years ago, after the Australian government called for an independent investigation into the origins of the COVID-19 pandemic, China retaliated with punitive tariffs on a range of Australian goods, from wine and barley to beef. It was a painful and humbling lesson in the realities of economic power. This places Australia in a constant state of geopolitical vertigo. From a security perspective, it is a key member of the AUKUS Pact with the United States and the United Kingdom, a military alliance explicitly designed to counter Chinese influence in the Pacific. But from an economic perspective, its prosperity is wholly dependent on maintaining a positive relationship with China. This balancing act is becoming ever more complicated. In a groundbreaking shift in late 2025, the Australian mining giant BHP, one of the largest in the world, agreed to settle up to 30% of its spot iron ore sales to Chinese customers in the Chinese yuan. This is no longer a theoretical discussion. This is a multi-billion-dollar transaction, the lifeblood of the Australian economy, beginning to be conducted outside the US dollar system. It is a pragmatic business decision that speaks louder than any diplomatic statement. Australia is trying to walk a tightrope, but that rope is being stretched to its breaking point between its security guarantor in Washington and its most important customer in Beijing. The inevitable choice, from Riyadh to Berlin, from Paris to Tokyo and Canberra, a clear and consistent pattern emerges. What we are witnessing is not a coordinated conspiracy to overthrow the United States. It is something far more organic and perhaps more unstoppable. It is a series of independent, rational, and cold-blooded decisions being made by sovereign nations, all acting in their own clear-eyed economic self-interest. For decades, in the unipolar moment following the collapse of the Soviet Union, these nations had little choice but to operate within the orbit of Washington. But we no longer live in a unipolar world. In the multipolar reality of today, with China providing a powerful alternative center of economic gravity, these nations do not just have another option. From their perspective, they have an obligation to diversify, an obligation to their own citizens and their own economies to hedge their bets. This is not betrayal. This is risk management on a geopolitical scale. What we are witnessing is the quiet, methodical construction of lifeboats. These nations remain for now passengers on the great vessel of the US dollar system, but they can see the storm clouds gathering on the horizon. They understand the risks of being completely dependent on a single currency, especially one that is increasingly being used as a tool of foreign policy through sanctions. And so, pragmatically and logically, they are preparing for themselves a means of escape. The end of the dollar era, should it come, will likely not be a single cataclysmic event. It will not be a sudden collapse. Instead, it will be a slow, grinding process of erosion, a death by 1,000 commercial cuts. Every trade deal settled in yuan, every call for a BRICS payment system, every central bank that diversifies its reserves away from US treasuries is another one of those cuts. We have now mapped the critical fractures appearing in America's traditional alliances. In our next analysis, we will zero in on the one nation that holds the ultimate key to the dollar's fate, Saudi Arabia. We'll uncover the secret history of the petrodollar agreement and reveal what its potential end would mean for global energy markets in your portfolio. Subscribe and click the bell so you don't miss this critical deep dive. History shows that alliances of convenience, even long-standing ones, dissolve when the underlying economic realities change. The great game of nations is, and always has been, about self-preservation. Looking at the current landscape, which longtime U.S. ally do you believe is making the smartest move for its own self-preservation, and which one is taking the biggest risk? Share your analysis in the comments below. This is a crucial discussion for understanding the complex world we are now entering. Thank you for watching.